When I made the video the other day talking about the random walk theory, I realized that I really don't have that much tech exposure in the Watchlist Wednesday portfolio. I mean, off the top of my head, I know we have Apple, Adobe, DocuSign. You might consider Peloton a tech company, Shopify, Spotify, and VGT. So maybe we actually do have a decent amount of tech exposure, but there's nothing wrong with adding one more tech company to the portfolio, right? Hey everyone, thanks for joining me today. My name is Matt, and today we are going to be taking a look at Cisco Systems. Now, before we get started, just have to say, this is not financial advice. Please don't take it as financial advice. If you have any questions, please speak to an advisor. This is just for your entertainment purposes only, and take everything I say with a grain of salt. Also, if you're new here, thanks for joining us. I do this every week. This is like week 24 in a row of me making one of these videos. So if you enjoy learning about stocks and other types of investment strategies, you might want to consider subscribing to the channel. It's free and only takes a minute of your time. But hold off on hitting that like button right away because I want to make sure you watch it to the end to actually make sure that you like this video. I'm looking for real results here and real feedback. So as I just mentioned, we're going to be taking a look at Cisco today. I keep wanting to say Crisco, like the oil for whatever reason, but it's Cisco Systems. Cisco was started from the husband and wife team in 1984 with Sandy Lerner and Leonard Bosak. Sandy and Leonard both worked at Stanford University, and they both had jobs that were pertaining around the computers that were at Stanford. The original product or system that they created was a network that allowed for the computers on Stanford's campus to communicate with each other. This product had some immediate success because it was actually able to scale very easily and was able to just hit a larger market without many difficulties or hurdles along the way. Now, when this product was created and started to get some traction, there was some discrepancies with the husband and wife team and Stanford actually claimed that they were going to file a criminal lawsuit for theft of intellectual property. They never did actually file that lawsuit, and Cisco hit the public markets for the first time in 1990. About 6 months later, Lerner was fired from Cisco, and her husband ultimately ended up resigning through a protest. Obviously, Cisco did go on to continue their legacy and build the name that we all know today, but it wasn't all bad news for Sandy and Leonard either. They each walked away, or in total, they walked away with about $170 million from the company. That'd be kind of a nice payday. So, quick fun fact here about Cisco is that the name actually comes from San Francisco. That's why Sandy and Leonard originally really wanted the C in Cisco to be a lowercase. Also, the logo actually comes from the Golden Gate Bridge, and I'll just pop up a picture here real quick so you can actually see the evolution of it. I thought that was pretty cool because nowadays with those dots, I mean, for all I know, it looks like the sound wave things when I talk into the microphone on my computer, but it's cool to know that's where that actual design came from. All right, so now let's go ahead and take a look at some of these numbers here for Cisco. Now, I just want to say I've been posting my videos on Reddit to kind of help grow my channel and just see what kind of feedback I can get. And one of the things I've actually been receiving is that you'd rather see more of the charts than for me to pop it up on the corner there. So I'm going to try it that way. And so that's why it's so big right now. Let me know too in the comments below if you like it this way or if you prefer the way how I pop it up on the screen and then just kind of move it off to the top corner like what the news does. So let me know your thoughts as well. As we can see though, I'm going to be comparing Cisco to IBM this week. I know they're not like a pure play competitor. They're very similar businesses, and I say that kind of hesitant, but they're close enough. They're both in a very similar industry. And again, I just like doing comparisons because I think it really helps give these numbers more meaning. As we can see, Cisco though, with a market cap of $165 billion, this is no small company. This is a very big company. IBM at $108 billion. So admittedly, I was kind of surprised to see that Cisco had a bigger market cap, but that's really neither here nor there. PE ratio of 14.82 and IBM has a 13.81. Reason why this is significant, and this is just the GAAP 12 trailing months PE ratio, nothing fancy. I didn't use forward or non-GAAP or anything like that. But interesting enough, these both have significantly lower expense ratios for tech companies. Usually tech companies' PEs are sitting around 32, if I'm not mistaken. So at 14 and 13, I mean, you could really look at both of these and say that they're undervalued companies. Beta, probably one of my favorite numbers out there or statistics, measurements, whatever, you don't really hear beta talked about that often, but I really like beta as a measurement. So as we could see, Cisco, a little less volatile than IBM and also less volatile than the market itself. Cisco's sitting at around 0.82 compared to IBM at a 1.17. It's been a while since I've said this, so if you are new here, basically a beta of 1 means that you're the market, and it shows the volatility and the standard deviation between you and the market. If your beta is below 1, you're less volatile than the market, and if your beta is over 1, then you are more volatile than the market. We could see here Cisco has a net income margin of 22.75% compared to IBM's 10.43%, which I thought was interesting as well. I mean, that is a 12% difference on a net income margin. So that is pretty significant of a difference there. And also, I'm going to jump more into this later, but net income has actually been going down for Cisco. Now, it's not a bad thing, but again, we'll touch more on that later. We could see IBM does pay a little bit better of a dividend or has a little bit higher of a yield. Either way, though, I think these are both very favorable dividend yields considering that they are in the tech space. So with Cisco's at 3.68 compared to IBM's 5.36, yes, I can make the argument that IBM's is more attractive, but again, that's not always a good thing, and I'm fine with the 3.68 for a tech company dividend. Payout ratio kind of goes hand in hand with the dividend yield, so makes sense for Cisco's to be lower than IBM's. Cisco's at 46.86 compared to IBM at 58.92. 58.92 admittedly is a little high, so it's not why I'm not taking IBM into consideration, but generally anything over 55% for me for that payout could be a red flag, and it's something that when I see that above 55%, I always want to take a deeper look at their balance sheet and make sure that they can support paying out that kind of dividend. As always, I really like to point this part out. So I know I kind of talk about the net income margin. That's basically what we're about to look at again here. We could see the revenue for the 12 trailing months for Cisco was $49.3 billion compared to IBM's $75.5 billion. But the net income was higher for Cisco than it was for IBM. Cisco had the $11.21 billion compared to IBM's $7.88 billion. So just shy of a little bit more than a $2 billion difference between the two. But also, can't forget that IBM's revenue was almost $25 billion more than Cisco's. Now again, without taking a full deep dive into IBM, I don't know, maybe they just recently purchased a company, maybe they lost a customer, maybe they're trying to go through customer acquisitions, which is going to be an expensive process for them. But I always like to see when a company doesn't make as much money and when it comes to revenue, but at the end of the day walks away with more money than the other companies do. So, applaud to Cisco because they seem to be doing a really good job with their revenue management, cash management, whatever you want to call it. Current ratio of 1.72. Man, it's been a while since I've seen a good current ratio. While it's not necessarily fantastic, it's still really good to see. And I'm actually, next slide is going to be a little bit more detail about this. But 1.72 for current and 1.58 for quick, that is awesome to see. Because recently I've been looking at companies with like a 0.8, 0.9, even down to like a 0.6. And as the investor, doesn't make me feel too settled, I guess you could say, when it comes to seeing those kind of numbers, because it just means that they'll have a harder time raising money. Maybe they're not handling cash well. So having that be above the 1, even closer to a 2 for both of those ratios is great to see. And obviously, as we can see, IBM barely above 1 and barely below 1 for the current and quick ratios. So that to me definitely gives me a little bit more confidence in Cisco than IBM. Again, I'm not saying IBM's a bad company by any means. Just from looking at these numbers, I would interpret that Cisco might be a little bit more favorable of an investment, but you might have a different interpretation. And really goes to show kind of the importance of looking more than just at the numbers. So next what I want to do is actually show you something from their balance sheet, which is new for me. All right, hopefully my screen doesn't cut this all off for you. This is from the consolidated balance sheet, and this is not something that I found or created or anything. This is from their actual balance sheet they have on their website, and this is something that Cameron Stewart, CFA, pointed out on his YouTube channel. He didn't ask me to do this. I actually asked him for a little bit of an explanation for it, and he graciously responded immediately. So if you like more of the in-depth numbers and charts and spreadsheets and all of that, not charts, but spreadsheets, balance sheets, cash flows, all those analyses, then definitely take a look at Cameron's channel because he is very insightful. It is a little bit more advanced and in-depth than what I talk about here on my channel because my goal is to make this as simple as possible. But if you're looking to further your knowledge from somebody with a very credible background, definitely take a look at his channel. So what you can see here we have is just a consolidated balance sheet, and if you look under current assets for investments, you can see that they have the 17,610. This is in billions, by the way, just if you're curious. And if we come down here, you can see short-term debt and long-term debt. Now, the total of both long and short-term debt is 14,358. So basically what I'm getting at here is they have enough in investments to cover the amount of short and long-term debt that they have, and then still be able to have money left over in investments. What we can see here is that Cisco now is in a position where they have more money in investments than they do in long and short-term debt combined, which is a very good sign for me as the investor because that is a sign of a very healthy balance sheet. This wasn't always the case for Cisco, and this is actually, I believe, either the first or second year that they've had more in investments than they have in debt. So that is a good sign to me because, again, it means that they're doing a better job with handling their cash. Now, what I want to talk about next, though, is their earnings call. All right, so this will probably be a pretty quick section here for the earnings call, but just a few key points that really stood out to me while I was listening to what they had to say. And first one is that 31% of the revenue they received is from their software service. Now, of that 31%, 78% of that comes from a subscription service. So more on that subscription later. Now, part of what led to the increase in revenue for the software service was an increase in demand for their SaaS services due to people working remotely more often. And by SaaS, I don't mean sassy like my dog. I mean SaaS is in software as a service.
Some things that really stood out to me, and I think this is where it's important to really look into the details and not just look at numbers and take it at face value,
is their revenue fell 9% and their net income fell 5%. Now, you could hear that and immediately assume that this company has issues going on and maybe just not even want to touch it with a 10-foot pole. But if you look into the details, that's actually a key thing to know because Cisco is switching more and more into a subscription-based service. As I said before, consumer, don't like it. As an investor, though, I really like hearing this subscription service because it creates that reoccurring source of revenue. And it really has two big impacts on the balance sheet initially. And the first one has to do, if you're selling a service for $1,000, well, now you're no longer getting that $1,000 that one time. Instead, what you're probably going to be getting is $50 monthly payments from a bunch of people. So at first, again, it's going to have that initial short-term impact on it, but it's also going to have that negative impact because they allow for free trials, which I do believe is essential. And as those free trials start, it is going to hurt how much money they're actually making, again, initially. But once those start to wrap up, then they'll start to create that revenue, and ultimately we should see those revenue numbers increase over time. So why buy it now? Well, one of the reasons, and this is not the biggest reason at all, but I know people like this, is if you look at this chart here from Simply Wall Street, Cisco is significantly undervalued. And I mean, again, take that for how you want because that's their interpretation using a discounted cash flow analysis. But it's good to see that a company that in this space is undervalued. Also, I'm not looking at this as like a growth company. I would almost invest in this with the same approach that I had for Realty Income, ticker symbol O. And reason being is because, yeah, I mean, this is showing that it's undervalued as an investment, but I don't think Cisco is going to grow rapidly. I don't think it's going to be like Peloton, where we bought it at 30 and it grows to 90 in just a few months. So I think that this is something that might be a slow and steady wins the race approach, but it also has no debt, as we saw, or very minimal debt and debt that they can handle, as well as it pays a fairly significant or consistent, at least, dividend. So no, not a monthly dividend, but for a tech company that pays a decent dividend, has minimal debt on their balance sheet, and is an undervalued company, I think we might have found a unicorn here because, yeah, IBM might be in the same situation. I know there's a few other tech companies, but a lot of tech companies right now have these absurd valuations. And I know that they're not tech in the sense of like Apple's iPhone or Xbox from Microsoft or anything like that. You know, it is a little bit more of those back-end things that you don't typically think about. But still, a tech company with this kind of valuation, to me, looks like such a good opportunity. And since they have a very healthy balance sheet, I don't see there being any reason of not putting this in the portfolio. Now, with that said, it's not going to be a huge purchase for us because, as I mentioned, we already have VGT in the portfolio, and the Cisco is the 10th largest holding in VGT. And so just again, to be cognizant of minimizing overlap, but I want to have a concentration in Cisco, I feel like it is worth adding just a small portion to offset risk from some of the other companies that we own, Molson Coors included. Because we do have some risky positions, and I think as we approach the year end come election time, of course I'm buying this for way longer than just year end, but it'll be nice and more settling for me to have something that can offset risk in volatile markets. So for that reason, we're going to add it to the portfolio. Let me go ahead and do that, and I'll switch over so you can see my screen, and I'll be right back. All right, so I was able to get 75 shares for $39.10. It was not easy. My computer's not working with me today, but about 2 hours ago, and right now it's trading at $39.51. So we made a little bit of a gain, but we're not after that short-term gain. Again, this is something that fits in the portfolio as more of an offset to risk we have from other positions while providing us some stable income. So happy with those investments. We also got in before the ex-dividend date, which is great. I didn't even know their ex-dividend date was, I think, tomorrow. So we got in at the perfect time for this. Depends if like this paper trading has to do with settlement days and everything, if we'll actually get that dividend. So I will keep you updated for that as well. As we could see though, portfolio's up $14,000 total. So everything's really headed in the right direction. We have 4 losers in the portfolio, but nothing has a loss more than $200 or maybe even $150. Never mind, $200. So I'm still happy with the investments we have in this account, but we are running out of cash. I only have $5,000 worth of cash right now in here, so little upsetting, but I'll have to figure that out when the time comes. Again, hope you enjoyed this video, and let me know your thoughts about switching up these viewpoints and how I've been structuring these videos, if you like it, don't like it, because while I'm a small channel, assuming that maybe one day I'll become a big channel, I really want to hear your feedback from you that have been with me this entire time, because that's what I value the most. And you know, I'm one point of view, but I'd rather hear from all of you to make sure not only are my videos creating value for you, but they're also entertaining, because finance is so cut and dry sometimes that I just try to do it a little bit differently. So let me know your thoughts if you have any suggestions either on companies I can review, maybe ways I can make these videos more entertaining, topics you'd like for me to discuss, or anything else along those lines. But with all of that said, we now have Cisco in the portfolio, so I like the way that things are headed. Anyway, I've been working on this video for too long now, so I'm going to wrap up here. Thank you so much for taking the time out of your day to watch this video. If you haven't already, hope that you like, comment, subscribe, all that good stuff. You made it this far, so you might want to hit it with a like if you haven't, or subscribe if you haven't, because still like 85% of you are not subscribed. But yeah, with that said, we're ending here, so thank you so much for taking the time out of your day to watch this. You could be anywhere in the world, and you're right here with me, and I really appreciate that. But I'll let you go ahead, enjoy the rest of your day, and I will see you next time.